So this is the first video I am attempting to gradually walk you through the remaining lessons. It's March 18th. We've received no guidance yet as to what's going to happen from April 14th onward. We know that the College Board has canceled SATs. They claim they might have an announcement at the end of this week about what will happen with the APs. But we just don't know. So maybe you'll have to learn this, maybe you won't. At least this first one will be a lesson on things we are all living through right now, and that's the government's response to an economic crisis. In this case, it's one of the few times we have an economic crisis created by government order or government suggestion to close down. So I will show you the slide, and then I'll talk a little bit about each one, and then back to a slide, and so on and so forth. So this is going to be on Economic Policy Part 2, the government's response. I know you've been waiting for a week to hear this. Okay, first off, I'll just remind you again of the two possible imbalances, diseases, or illnesses that affect the economy. The first one's on the right. It's the one we are not experiencing now, and the one I told you about that we haven't experienced for decades, and that's hyperinflation. That being said, we might have to deal with it in 6 months, later this year, as all that money accumulates that's not being spent, that's already out there in the private sector and just isn't being spent because nothing's opened. You can't buy things. Or eventually there will be a limited amount of things as shelves get emptied. Added onto that, the $1 or $2 trillion that the government will infuse into the economy, and then the money that has been accumulated in people's pockets as they sold off stock, all of that is going to be pent up and want to go out and buy at some point. And that's a lot of money out there to buy. And two, as I said, there might not be anywhere near as much stuff to buy. Only so many airplanes can fly and take people to only so many vacation spots. And you're going to have a lot of people maybe wanting to do that. Obviously, inflation and potentially hyperinflation. So we might see the government having to deal with that as a consequence of their policies now to deal with recession. Now, I'm not in the classroom, so I can say recession. It's not the Oval Office. So just to remind you, a lot of money is out there. The old quote, too much money chasing too few goods results in prices going up quickly. I also want to remind you that the primary indicator of that is the consumer price index, although there are other indexes that you'll notice massive spikes in prices. And you'll also note on the slide that the ones who are most harmed are the ones whose income is set, is not flexible. They're hourly workers, they're retirees, their salaries may not be adjustable. They have contracts that set salaries at a certain level, so they're not automatically built in to compensate for higher prices. There are a lot of them that are impacted that way, which you think about that politically, with large numbers hurt by hyperinflation. It's no wonder the government has invested a lot of time and energy into the last 40 years of preventing it. It really ticks off a lot of people, and they tend to take that out on whoever's in office at the time. It is a major contributing factor to Jimmy Carter's defeat in 1980 to Ronald Reagan. So that's hyperinflation. So I'm going to put up this slide again showing you the opposite situation, which we are drastically entering now. Okay, the next chart shows the opposite effect. The economy has been revving up, and it has been revving up. It's been producing things to buy, vacations to go on, plane flights to take, etc. Then all of a sudden, not as a result of sort of the trends of economics, people just aren't being allowed to buy those things. So the people who produce those things, provide those services and eventually goods, are being laid off. So obviously you see for a recession, the indicator is going to be a significant increase in the unemployment rate. And you may have seen in the news that they've been talking about a 20% figure. And if you recall in class, I talked about that being the sort of standard procedure for some of the Southern European countries. It is shocking. You get to 10% like we did in the Great Recession, and pitchforks and torches are coming out in the American public. 20% would really cause some panic, other than the fact that it's a result of this virus, not necessarily the consequences of a bad or mismanaged economy. So this is the recession. This is what we're dealing with now. So we'll certainly be able to reference things that the government is doing now as an example as part of this lesson. So now what is the government to do? We remind you of our first lesson that until primarily the 1930s, it was nothing. Predominantly, they would just step back and let the market forces correct itself, laissez-faire economic policy at the national level, dealing with the consequences for people's lives of losing their job, losing their homes, etc. It's not like no government was doing anything until the 1930s. It was primarily the responsibility of state and local governments and or the communities. But things got, as you know, so bad in the 1930s that Franklin Roosevelt had to accept, reluctantly, being a 19th century kind of guy, that the government needed to take more action. And as you saw on the slide, along comes the English economist John Maynard Keynes with the notion of let's use the government's ability to tax and spend to manipulate the economy, to work out, smooth out the rough edges of capitalism, to keep it from getting too hot and thereby risking inflation, or getting too low and thereby impacting or creating or trying to mitigate the consequences of an economic downturn, whether or not they were tossing around the word jelly donut or recession or depression back then. I don't know, eventually they do, but they weren't thinking in terms of what's the government going to do about it. Now, what does that look like? The political branches, Congress and the president, come together. That's quite a challenge in these days, to either increase taxes, making choices about which taxes to increase, who to tax, whatever, part of the political process, or increase spending. And that has a whole nother set of decisions to be made, as we are seeing playing out right before our eyes in Congress, as they decide, okay, we're going to do something with $1 trillion. Well, what are we going to do with it? I mean, it's a nice concept to say we're going to help the economy by injecting $1 trillion. As the old saying goes, the devil's in the details. So they have to make decisions as to who gets that money, how much money, what do you qualify for, who doesn't get the money. There's big debates now going on about payments to individuals. What individuals? Should there be payments to corporations at all? Should we just supplement corporations' bank accounts to continue to pay their workers? So the workers are getting compensated through their employers and not in a form of a check from Uncle Sam. So those decisions are left to the politicians. Now, Keynesian economics as a concept, as a theory, as a mechanism is fine. The fact that real-world politicians in a real-world Madisonian-created government with checks and balances and thrown into that partisan politics and thrown onto that the hyper-partisanship of today's social media world, it makes it in practice a very challenging thing to do. At the end, I'll talk about how how fiscal policy, Keynesian policy, can be used to fix a recession or hyperinflation. But that is what Keynesian economics is about, and this is probably just a mere reminder of what you learned already in economics class. Now, after the Federal Reserve became the sole controller, if you will, of the supply of money in the economy, it was determined they could play a role in this. They could impact the health of the economy using the tools they had in the law to manipulate the supply of currency. Now, they do that and this is a very gross oversimplification of it. They do that in one of three ways that you can see on the screen. They obviously, you're hearing about interest rates. We've talked about it previously with the Great Recession, and then just this week they cut the interest rate to 0, which means it's costing nothing for appropriate financial institutions, the banks, to come and say, we need $1 billion. They'll just say, here's $1 billion, and you don't owe us any interest on it. Ideally, then there would be a domino effect, and the banks would not charge as high interest for car loans or whatever, or maybe second mortgages or any other financial activity that might assist the economy. Keep in mind, and we'll talk about this, I'll go over this again briefly later, 0 is as low as you can go. They can't pay people to take their money. The other is they establish for banks a set amount of money to hold in reserve, cash on hand, if you will. They can manipulate that amount. So if they want to deal with a recession, they can say you don't have to hold as much cash on reserve. That should therefore mean that there's more cash out there to loan, and the greater supply of something means the price will go down, interest rates will go down. The last one is, and this is another thing you've heard about, we've talked about, is they can either sell treasury bills, in which case they are taking money out of the system. People are turning over cash in exchange for a treasury bill that entitles them to certain interest payments over a period of time. Or they can buy them back, in which case they're cranking up the printing presses and taking back with some bonus these T-bills, thereby pushing cash into the system. That is monetary policy. Much to Donald Trump's chagrin, it is under the control of the Board of Governors, in this case led by, I think his name is Powell, the chair. And for months, if not years, Trump has not necessarily been happy with their decisions. The Fed, as it's called, is intended to be only quasi-political. Their people are not elected, obviously. They are not traditional presidential appointees in that they serve at the pleasure of the president. They are appointed by the president, they are confirmed by the Senate, but then, as we mentioned on a couple of occasions, and we'll come back to, they serve for a set period of time. And there are generally groups, boards, commissions, etc., that are made up of multiple members, and their terms are staggered. So no single president, no single political moment can necessarily influence their ultimate decisions. So that is monetary policy. The picture shows you Alan Greenspan, by many considered to be a very important chair who made decisions that potentially, in conjunction with the chair before him, a guy named Paul Volcker, moved us to successfully eradicating hyperinflation from the American economy, at least knock on wood for the time being. Now, as you saw in the slide, there is a third option, whether we call it option 3 or option 2.5. In the early 1960s, an economist that you see pictured there, Alan Laffer, came up with this idea of stimulating the economy through cutting taxes, this variation of fiscal policy. Rather than spending money, cut taxes. This has become Republican orthodoxy in how to approach recessions. John Kennedy was actually the first one interested in it, although economically he was conservative by today's standards. Reagan really bought into this philosophy of cutting taxes to stimulate the economy in a recession. And without being too oversimplistic, it appeals to Republicans because, in theory, you're still infusing money into the system to buy down that excess supply, but it's in the hands of the private individuals. The government is not choosing where to spend the money, who to give money to, or what excess goods and services to purchase. That's the government, that's socialism. Let the people do it. So stimulating the economy through tax cuts. Now, you'll see it would be helpful if in good times you had generated a reserve fund of cash so that while the economy turns around, you don't have to go into massive deficit spending to fund the tax cut. You know from the FRQ we did that if the deficit increases each year, the debt increases, and you have to siphon off money just to pay off interest on the debt. So you're doing sort of two contradictory things. You're trying to stimulate the economy by putting money in circulation, but you're also breaking the economy by perhaps artificially raising interest rates because the government sucks out so much money just to make up the deficit. You hear it now. One of the things Trump talked about earlier was a cut in payroll taxes, particularly Social Security, for a period of time. That's very much within the Republicans' wheelhouse. You will now see, however, things have gotten so much worse since then that has, at this point, as I record this actually on the 19th, that they've largely shelved that for the time being, maybe for some future round of stimulus, but they're now talking about $1 trillion and just let's pump it into the economy. Very much Keynesian at a grand scale in a very short period of time to deal with a very unique circumstances. So that is supply side economics, and that is credited to the economist Laffer. So the previous slide shows you the imbalance known as a recession, but I want to talk briefly about hyperinflation. And again, as I said, it could come at some future point because of things we're doing now. So how does fiscal policy work when you have hyperinflation? Well, there's too much money out there. Fiscal policy is taxing and spending, so you're not going to spend, you're going to tax. You're going to pull out the excess money to create a better balance between supply and demand. Theoretically, that is going to give you, hold on to your hat, surpluses, which it's important to bank those surpluses, as we will see, for the day when the rain comes. We really don't do this. Going back to tossing the tea into the harbor, Americans' aversion to taxes. We have occasionally done it. One instance I can think of is the massive profits that were being made, not financing, but producing goods to fight World War II. Resulted in some very high tax rates for the uber wealthy and the corporations that were involved in making tanks, bullets, ships, etc. It was clearly a small print. It was hyper taxing the 1% who were profiting massively as a consequence of fighting the war. So politically, it was a winner. It faded over time, and now we seem to be locked in a period where it's very, very hard to raise taxes for anything. We will see down the road, a year or two, if something is done to try to finance what we do now. As I mentioned before, we did not do that when we decided to finance the war on terror. We just added that to the credit card. Now, in times of a recession, the government will not tax, it will spend. And going back to the time of the New Deal and right up to today, it's how do we spend? Who gets the money? How much money? That's a political decision. It's a complicated decision. There was obviously an emergency in the 1930s, and a massive Democratic majority in Congress. So FDR comes along with, I'd like to spend on this, I'd like to spend on this, I'd like to spend on this. It was mostly pretty quickly approved in 1933 and 1934. Now that slowed down considerably later as political balance was restored. More conservatives were elected back to Congress. We're seeing that decision play out right now. They are sitting there on their social medias or however they're communicating, or the Senate's in session, and they're trying to, they've got to figure $1 trillion, and they're having to make some pretty quick choices as to where do we insert this money. Do we do it directly? Do we just give people money? That seems to be accounting for perhaps as much as $500 billion. Do we purchase excess goods and services by supporting business, etc.? That could be another quarter to nearly the remaining half. There is obviously, this has to be done quickly, so hopefully they're managing to put some thought into it as well, because you are talking about $1 trillion. So fiscal policy attacks a recession by spending, with all the choices that come from that. Having to accept, and this was a difficult thing even for Franklin Roosevelt, that you're going to have, knock on wood, short-term deficits, but that the long-term health of the economy is worth it. And theoretically, if you were taxing excess money in a hyperinflationary period, you might potentially have a rainy day fund to tap into to not necessarily have to go directly into deficit spending. So that is fiscal policy attacking each illness. Monetary policy is a little easier to explain. The Fed can't buy anything. The Fed can't send payments to people. The Fed can't pay for a new bridge. So they don't affect the supply side at all. They simply affect the amount of currency in circulation. And if you go look at that slide, it's very easy. If they want to insert money in times of a recession, they lower their interest rates, they lower their reserve requirements, and they buy back treasury bills. It's not too complicated. If we ever have a hyperinflationary period, they do the opposite. They raise interest rates, they raise the reserve requirements, and they sell treasury bills to take money out of circulation. So that one's pretty simple. You just got to try to remember which direction each lever goes in which circumstance. Okay, on this rather detailed last slide, I'm going to walk you through some considerations that impact the use of either policy on trying to fix inflation or, more obviously, frequently recession. As I mentioned already, interest rates can only go so low. So in terms of what the Federal Reserve can do on interest rates, dealing with the recession now, they've done it. They've gone to zero in a lot of cases. It's called quantitative easing when they are buying back those bonds. They could lose control of it, and there was concerns. In fact, even last year, the Fed was thinking they might have done too much of this, that inflation was on the potential rise, so they were ticking up on their interest rates a little bit as a consequence, and it annoyed Donald Trump, but now obviously things have completely turned around regarding that. The other thing is it definitely inflates the value of the American dollar, which makes it hard for export industries to sell their goods. And American consumers are then tempted to buy foreign goods because they become a better deal. We know in terms of limiting Keynesian, in terms of Keynesian economics, that Americans don't like tax increases. About the only thing you can do with taxes is lower them. Or as the next one is, you manipulate the tax code. And now that has become a challenge because it's been manipulated to death. And we talked about the impact of all those tax expenditures on the economy. On the budget, on whether or not we can balance the budget. When you are trying to save money, we've seen in the FRQ, there's limited places you can save, and even if you could save some and impact the economy, those devilish iron triangles come in to prevent cutting the budget. In order for Keynesian economics to work, you need to, based on economic circumstances, raise spending, move spending, lower spending, raise taxes, lower taxes. So to some degree, Keynes was living in a fantasy world that this was going to be done by economists and not have to deal with the political reality of America. He was wrong. And as I mentioned, a good portion of the budget, as you see that next to last item, is uncontrollable, very difficult to maneuver from year to year. Certainly not going to do anything about it now to deal with a recession that ideally is artificial and hopefully will be over in a matter of weeks, if not months. And then the final one, in terms of the political implication, it depends on where you are in the term. You see Reagan, the interest increases to fight inflation, the tax cut to stimulate the economy, all occurred early in his first term. Whether that was by happenstance or on purpose, whether he was brilliant or just lucky, those things were done early in his first term. The Republicans, paid a political price in the 1982 midterm elections. But by the time, as you know, 84 comes along, they had worked. Inflation was under control. The economy had been stimulated. Reagan took credit for it, rightly or wrongly, and won 49 states. In the case of his vice president, the first President Bush, the recession, while mild in comparison to the economic crisis of the early 80s, hit late in his term. He, as a traditional Republican, was not necessarily amenable to immediate fiscal responses. Monetary policy is slow to take effect. There is, as you see, a lag time. While technically the recession in 91, 92 was over by technical measurements on election day. The people weren't feeling that yet. That lag time to feel like things were getting better wasn't there. And as a consequence, among other things, he is not reelected. This is our current circumstances are very bizarre. Yes, it is late in his first term. It could be similar to what happened to the first President Bush, but to Trump's credit, it's not like he created the virus. He's having to deal well or not well with the consequences of it. So we shall see where we are in months, and certainly by November, whether there is any impact on the election, and then it'll be for future study of government to determine. So that is, in a nutshell, the government's response to economic problems and what tools are at their disposal.